What does it mean to be a dividend king? A stock that has increased its dividend payment every year for at least the previous 50 years. It is highly likely that the majority of these dividend kings will continue to be featured on the list throughout the entire year of 2022. Why? Companies that have maintained a consistent pattern of dividend growth for more than half a century are under a great deal of pressure to maintain that trend moving forward. No chief executive officer ever wants to be remembered as the boss who botched an exceptional dividend track record. Investing in stocks that have a history of consistent dividend growth over the long term, a significant portion of the money that is spent on research and investment can be saved, mainly due to the fact that steady dividend hikes throughout time are often an indication of excellent financial performance. And a business that, like kings and aristocrats, has been able to flourish despite the passage of time. As a direct consequence of this, it is highly likely that they will maintain that excellent financial performance for the foreseeable future. There is an old adage that goes something like this: one's past performance is no guarantee of one's future results. Yes, that is a valid point. There is no assurance provided. However, a strong historical track record of dividend payments over a prolonged period of time is an important step in the right direction, to have a favorable outlook toward the opportunities that lie ahead for a company. Here are 5 dividend kings. Number 5. Cincinnati Financial. It is a shareholding in an insurance company. In addition to providing insurance for businesses, homes, and automobiles, the company also sells a variety of financial products such as life insurance, annuities, property insurance, and casualty insurance. It does it in 2 different ways, given that it is an insurance firm. It does this by collecting premiums on policies that it writes and then investing its float, which is the big quantity of money that results from adding the time value of the premium revenue to the amount that it pays out in claims. It released the results of its financial performance for the second quarter on July 28, 2022. Earnings per share adjustments came in at 65 cents, which was 39 cents below what analysts had predicted, and earned premiums came in at $1.77 billion, which was $190 million below what analysts had predicted. However, earned premiums increased by 11.3% as compared to the previous year. Since the beginning of 2022, book value has decreased by $15.42 per share, bringing it down to $66.30 at the end of the quarter. During the first half of the year, the company had a value creation ratio that was negative by 17.2%, which was the opposite of the positive 11.6% value creation ratio that it had during the same 6-month period in the previous year. The dividend was raised to 69 cents per share on a quarterly basis on January 28, 2022, a 9.5% increase from its previous payout. This marked the 62nd year in a row that the payout has been increased. We anticipate a 6% yearly growth in EPS until the year 2027. In addition to that, the stock offers a dividend yield of 2.8% at the time. Last but not least, it would appear that the share price is too low. Over the next 5 years, it is anticipated that the total returns will average 12.1% each year. Number 4. Parker-Hannifin. It is an industrial manufacturer that specializes in motion and control technology and has a diverse product line. The current yearly revenues of the corporation are around $14 billion, and it was established in 1917. It has been increasing its dividend payment for an impressive 65 years in a row, which brings the total number of years it has been paying dividends to 71. It reported its financial results for the third quarter of the fiscal year 2022 at the beginning of May. Strong demand in practically all markets was able to more than balance the negative effects of cost inflation, which resulted in a 9% increase in sales when compared to the same quarter of the previous year, and a 17% increase in adjusted earnings per share, which went from $4.12 to $4.83. It not only produced record sales and earnings per share, but it also outperformed analyst expectations by 18 cents. Additionally, it increased the dividend by 29% while simultaneously narrowing its projection for adjusted earnings per share in fiscal 2022 from $17.80 to $18.30 to $18 to $18.30. Our forecast calls for annual total returns of 12.1%, which will be driven by EPS growth of 9%, a dividend yield of 1.6%, and an annual boost of 1.5%. Number 3. Computer Services. It offers a vast array of services to regional banks, including solutions for core processing, digital banking, payment processing, and regulatory compliance. Because of its relatively low market capitalization of $1.4 billion, it is classified as a small-cap stock. Enterprise banking and business solutions are the 2 primary business facets that the organization caters to. The enterprise banking group is the more important segment, accounting for approximately 62% of the total revenue of the corporation. It has increased its dividend, earnings, and sales for a total of 50 consecutive years, 22 years, 25 years, and 25 years respectively. The management of the company anticipates that the aforementioned measures will reach new all-time highs in 2018, thanks to the robust momentum of the business. Over the past decade, it has increased its earnings per share at a pace that is 10.2% more than the average annual rate. Its performance has not been adversely affected in any way by the epidemic. The success of Computer Services' business plan can be inferred from the company's remarkable track record of revenue expansion. The firm enters into multi-year contracts with its clients and provides them with a comprehensive selection of services to choose from. Because of this, it is exceedingly expensive and inefficient for these consumers to discontinue working with the company, particularly given that they pay considerable early termination penalties, which makes the situation even worse. The dividend yield on the company is 2.8%, and we anticipate an annual EPS growth rate of 8%. The expansion of the price-to-earnings multiple is anticipated to contribute 1.7% annually to total returns, which are forecasted to reach 12.5% annually. Number 2. Lowe's Companies. Lowe's Companies are the United States' second-largest home improvement specialty store after Home Depot. More than 2,200 home improvement and hardware stores in the United States and Canada are serviced by or operated under the auspices of Lowe's. On May 18, 2022, Lowe's released its financial results for the first quarter of the year. When compared to the previous year's first quarter total sales of $24.4 billion, this year's first quarter sales came in at a total of $23.7 billion. Comparable sales experienced a decline of 4%, while declines in comparable sales for home renovation in the United States were 3.8%. It is important to note that sales to professional customers increased by 20% year over year. The net earnings of $2.3 billion were comparable to the numbers from the first quarter of 2021. An increase of 9.3% was seen in diluted earnings per share, which rose to $3.51 from $3.21 a year earlier. During the first quarter, the business spent $4.1 billion to buy back 19 million shares of its own stock. In addition to that, they distributed dividends totaling $537 million. The amount of cash and cash equivalents held by the company currently stands at $3.4 billion, maintaining a good liquidity position for the company. The company has presented a forecast for the upcoming fiscal year of 2022 and anticipates that it will be able to generate diluted earnings per share in the range of $13.10 to $13.60 on total revenues of approximately $98 billion. In 2022, Lowe's anticipates that it will repurchase common shares worth a total of $12 billion. The combination of an increased multiple, an anticipated increase in earnings per share of 6%, and a dividend yield of 1.8% results in total predicted returns of 14.5% per year. Number 1. 3M Company. More than 60,000 of 3M's products are put to use every day in households, medical facilities, commercial establishments, and educational institutions all around the world. It has a workforce of around 95,000 people and provides services to clients in over 200 countries. It is currently divided into 4 distinct business units. In addition to the production of personal protective equipment and security goods, the Safety and Industrial Division is also responsible for the creation of tapes, abrasives, adhesives, and software for the supply chain management. The Healthcare Division is responsible for the distribution of medication delivery systems, in addition to medical and surgical supplies. Fibers and circuits are produced by the Transportation and Electronics Division with the intention of utilizing renewable energy sources while simultaneously lowering costs. The Consumer segment is responsible for selling things like protective materials, office supplies, home improvement products, and stationery supplies. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.